Welcome back. Now to our next conversation. The IMF has concluded its 2022 Article 4 consultation with Nigeria and noted that there is urgent need for bold fiscal reforms to create needed policy space, put public debt on a sound footing, and reduce vulnerabilities. For analysis now, we have Dr. Omobala Adu, investment research analyst at AfriInvest. Great to have you on the show. Good morning.
Yeah, good morning, Lady. Nice to be here.
So what can you tell us about these needed reforms the IMF spoke about and the expected impact on the economy?
Yes, thank you, Lady. So for context, the IMF usually meets with its member countries usually once a year. And what they basically do is to collect economic data, financial information, and have discussions with country officials on their expectations for the economy, and then discuss that with the IMF Executive Board. So what we have today is a summary of that meeting with the IMF staff have had with the Executive Board. And basically, they've mentioned some key reforms that are not new to our hearing. So they talked about the removal of fuel subsidies and as well as revenue mobilization through tax reforms. So these are not new things that we've heard so far. In terms of the fuel subsidy, we know that fuel subsidy is a big drain on Nigeria's physical capacity. If you look at, we had plans to remove fuel subsidies last year, but that has been delayed to this year. And based on expectations and estimates, the fuel subsidy is supposed to cost us around 3.4 trillion if it's removed by mid-year. But if it stays to the end of the year, while we're seeing fuel subsidies impacting the government's budget by roughly 6.4 trillion. Now, if we look at that in terms of the impact on the budget, we are seeing that funds that could have been channeled to more economic stimulating activities that would then have multiplier impact on the economy in terms of boosting growth, employment opportunities are being channeled to fuel subsidies. If you also look at it from the context of what we're spending, the budget is roughly around 20.8 trillion. Removal of subsidies would mean a budget less than roughly 3 to 6 trillion, which will give the government more room to channel funds into capital expenditures that are likely to bring about economic impact on the country. And then it even is from the expenditure side. If we look at it in terms of the fiscal deficit is estimated at over 10 trillion this year. We will see the impact of fuel subsidies and the cost in terms of visiting the capital market in terms of borrowing. So it's not news that fuel subsidies are a huge drain on our fiscal capacity, even if you look at it from the angle of revenue, right? On the average, close to 73% of crude oils are swapped in terms of PMS. So we're also looking at it in terms of subsidized revenue. We know that in terms of revenue, the government is projecting around 9.7 trillion, but given historical underperformance, we're likely to see 20 to 30% shortfall on that angle. So in terms of fuel subsidy, this is a discussion that is basically not new. We've had these discussions severally, and it's time for that the government needs to consider the impact of these subsidies in terms of what it's doing for the budget. Now, in terms of revenue mobilization, right, the IMF highlighted the need for bold tax reforms. We know that in terms of tax revenue to GDP, Nigeria has one of the lowest compared to African countries, roughly around 7% of GDP. This is about 10 percentage points just from sub-Saharan Africa's average. And the reasons are not far-fetched. If we try to look at why Nigeria's tax revenue to GDP is basically low, we can look at it in terms of three perspectives. One, in terms of the tax rates, in terms of VAT tax rate around 7.5%. We can also look at it in terms of the perspective of the tax payment system and also in terms of tax compliance. Speaking to the first, we know once again, Nigeria, in terms of VAT, we pay one of the lowest compared to Africa's average, roughly around 18 to 20%. And we've seen in terms of the Finance Act and some of the things they want to make in terms of reform of VAT moving to maybe 10% or between 15 to 20% subsequently. If you also look at some proposals in terms of introducing a sales tax of around 10%, if that is done, we are seeing an effective tax rate of close to 28%, which will make it one of the highest in Africa. But then again, we consider the downside effect. Even though on the upturn, we are seeing more revenue for the government, it just means more economic hardship. So playing that route might not be the best move for the government. We think we need to see improvements in terms of the tax payment system and in terms of tax compliance. Now, in terms of the tax payment system, Nigeria ranks around 159 out of 189 countries in terms of the ease of paying taxes. In fact, we make on the average 48 tax payments in total, and it takes on the average over 349 hours for tax for companies or individuals to comply with tax obligations. If we compare that to Sub-Saharan Africa's average, that's roughly around 280 hours annually. So we can see that even from the tax payment system compliance, we're seeing that it's basically more difficult to pay taxes in Nigeria compared to our African peers. So we need to look at ways in which we can bring in better automation that make the tax payment system easier. Okay. And then it encourages people to comply with taxes better.
All right.
And finally, in terms of tax compliance, we see that generally we have this perceived low level of tax compliance in Nigeria. And if you think about it from the impact, we know that we have a situation where most Nigerians complain that they are not seeing the impact of their taxes on the economy in terms of infrastructures. If we also look at it from the perspective that a number of medium, small enterprises operating in the informal economy are outside the restrictions of some of the formal channels, it then just exacerbates some of the challenges that the government is facing in terms of raising revenue from taxes. So combined together, if we see some of these reforms coming in, although in terms of the full subsidy, it means that the economy will have to go through a period of pain. But at the end, we see that in the long run, then we stand to gain more. On an optimistic basis, we see that this year the country could do roughly about maybe 3.9% in terms of growth if some of these bold reforms are being put in place that the IMF has rightly mentioned and some of the discussions we've had over the past year.
All right, Dr. Adu. One other recommendation the IMF gave was for the CBN to be decisive, on tackling inflation. And, they've done about 600 basis points, from 2022 till now. But they say if inflation keeps going up, the CBN should raise rates, even more. How do you see that?
Yeah. So just like you rightly mentioned, if we look back to the ending of 2022, we saw inflation moderating to 21.3%, which was the first moderation in over 11 months, coming on the back of the CBN Monetary Policy Committee raising interest rates by over 500 basis points. And this year, they've come back on another 100 basis points increase. Now, in terms of the impact on inflation, first of all, we believe that inflation is likely to moderate this year down to about 17.7% on the average compared to last year's average of around 18.6%. And one of the major reasons why is the high base year effect that we experienced in 2022. So barring any unexpected shock this year, we see inflation moving on the downtrend. We saw that last year it was the escalation of the Russia-Ukraine tensions that helped stoke commodity prices globally and fueled our inflation. But this year we're seeing that if we don't see unexpected events, inflation is likely to move on the downtrend. And that means that the CBN is more or less likely to embark on the hiking spree that we saw last year. If you look at what they've done this year, the 100 basis points, we believe that there's possibility of another room of another 50 basis points hike in inflation. But in general, we believe that inflation is more likely to moderate this year, which means that the CBN might be more or less likely to embark on a hiking spree. But in the event that we see the opposite happening in terms of the implications, the direct implications will be in terms of increase in the cost of borrowing. We're seeing cost of borrowing of companies basically increasing, and that has a negative impact on in terms of profit, but in terms of profitability, and also for an individual basis, it means that less people would be more willing to visit the financial market to take up loans, considering obligations to pay back.
What if, the central bank, keeps hiking rates, but, at the same time, still making loans available to the federal government through ways and means? What happens?
Yeah. So we know that's rightly that the government has already made plans to securitize the ways and means. So if we see the possibility of that continuing, it also speaks to the first point in terms of the needed reforms that have to be made. So currently, ways and means are roughly over 20 billion today. So in terms of the context of what that is happening, it means that we're just likely to see more physical body strains. Debt service to revenue, currently over 80%, means that the government is basically paying more on borrowings, and then it does have an impact in terms of their capacity to come back to visit the capital market in terms to raise new borrowings. So we are seeing a situation where the government has to do the right things in terms of stopping the overdrafts that have been made to CBN. We need to move back into terms of what is constitutionally right. By the addition of the ways and means estimates, we're seeing the debt profile likely to jack up higher. We're seeing the debt to GDP ratio move closer to the DMO's threshold of 40%. Currently, with ways and means, we're seeing debt to GDP ratio at over 30%. So we're already in a worrisome state in terms of our fiscal capabilities, and therefore there is need for the government to look at ways to quickly move to securitize the ways and means, and also try to restrict these advances made to government in terms of, we look at it in the impact of how these funds come into the economy and improving or increasing the money supply, and then its indirect impact on inflation in the country today.
And I know you at AfriInvest, you're giving your growth forecast for 2023, but with what's happening now, with what we've seen in January, from the currency swap to the fuel scarcity, are you looking at revising that forecast?
Yeah, so thank you for that question. So if we first of all look at the Nigerian economy, first of all, the economy has proven to be resilient. If we look back at what happened in 2020 in the midst of the pandemic, most people expected the economy to severely contract, but we saw that after the decline in the second quarter and third quarter, the Nigerian economy came out of the recession in the fourth quarter of 2020. So it basically showed us that indeed the Nigerian economy has been proven to be resilient in terms of challenges being faced. Now, if we look at the current happenings in the economy in terms of the currency crisis and the fuel scarcity, we believe that these shocks are more or less temporary events which are likely to phase out before the end of the first quarter, especially on the Naira redesign policy. So based on these expectations, we still hold on to our base assumption that this year the economy is likely to grow roughly by around 3%, barring any unexpected events to happen. Just like we directly mentioned, these things we're experiencing are not likely to be permanent shocks to the economy, but just a temporary phase that are likely to phase out within the next month or two.
All right, let's hope for no unexpected shocks going forward in 2023. Thank you so much, Dr. Omobola Adu, investment analyst at AfriInvest. Thank you so much.
Yes, thank you for having me.